Welcome to our YouTube Live here to talk about Silicon Valley Bank. I've got about 30 seconds and we'll get going. Okay, I just got the thumbs up, so we're good to go. Welcome to our live today. I wanted to put this together after the events of this weekend. Certainly when we hear about bank failures and things like that, it harkens back to some dark times in the '08s and '09s and the crises that we've had. Many of us have been through other bank crises where we've seen headline banks getting shut down for a variety of reasons. Many of us in Iowa are familiar with the S&L crisis and what happened with the farms and all those kind of things. So whenever we hear this, especially in today's media environment, it can be very unsettling. And so I've spent some time researching what happened, what it might all mean, and wanted to just share some thoughts as to why I don't think the sky is falling, why I think this was a bit of a one-off. But I also would say that when I've been speaking with all of you over the last 6 months or so, I've been saying we'll be talking about something different. We were talking about Ukraine and we were talking about other challenges and rates going up so quickly. And whenever things change so dynamically in the marketplace, there's going to be unintended consequences. And so what I think we've seen here is the beginning of that, is with the high rate hikes, interest rates going up, and just this crazy persistent inflation. It's created a new dynamic in the markets, and this is one of the pieces that fell out from that. So wanted to talk about a few things with the situation, but first and foremost, I want to talk about your money and the money that you're holding with either TD Ameritrade or Charles Schwab. Just so everybody knows, that conversion from TD Ameritrade to Schwab is going to take place over Labor Day, so later this summer. And everybody will move over to that platform. We're being assured there'll be limited impact and limited paperwork that goes with this challenge. But nonetheless, the assets that are held at these custodians, as I mentioned when we left Morgan Stanley and came to TD Ameritrade, they're the custodian of your assets. They hold those, but they're yours. So they don't have any ownership of those stocks, bonds, securities per se. It's yours. And so if you wanted, you could get paper certificates for all your stocks and put them in a safe deposit box, things like that. So they're held away is what that means. And so just want to assure everyone that your securities and everything are safe and remain that way. In addition, the cash that you hold in these accounts, in the money market accounts or wherever, those are FDIC insured deposits. And if you get over the limit, the $250,000 limit, they add another bank to the platform or portfolio to split that up, so you're continuing to get FDIC coverage on your deposits. So everything at these custodians are safe, and that hasn't changed. And regardless of what happens with these banks and some of the fallout that may come in the regional bank area, it's not going to have an impact on the safety of your money. So I wanted to make sure to assure you there. So why do we diversify? Why do we talk about diversification all the time as investors? Because we know that if we take single stock risk or overdo one area of the market, overweight heavily into one asset class, we are taking on undue risk. So Silicon Valley Bank, from what I can understand, took a lot of single area risk in venture capital and technology upstarts and things like that. And so they became a big bank, bringing on all these deposits in an era where there was zero interest rates, essentially. So they could load this stuff on their balance sheet and then loan that money out and do whatever. Well, once someone alerted their friends in the Silicon Valley Bank network, Peter Thiel, on Wednesday, that there was concerns about the solvency of the bank, what you had is an old-fashioned bank run. People all wanted to get their money out. So here's what happened in this dynamic that's a little different than what we've seen in the past is, so the bank's investing their money in bonds, in treasury bonds in particular. And so as we all know, bonds over the last year have gone down in prices. It's a weird dynamic, but when interest rates go up, bond values and bond prices go down. We all saw that in the bonds that we held in our accounts, or in the individual positions, and maybe the exchange traded funds that we hold for those bonds. So they're experiencing the same thing. So if they had a bond that used to sell for $100, par value, and that goes down to 80 because now all of a sudden people can get 5 and 6% treasuries, they don't want your 3% one anymore. So the price of that comes down. Well, when there's an emergency, and they have to get to cash quickly, they had to sell those bonds at a loss. And so when that starts happening in perpetuity, it's checkmate. And that's exactly what happened here, is that they had to start selling these bonds. They were marking all the losses they're taking in those bonds, and then boom, they had a solvency problem where they needed more cash and liquidity to meet their needs and the depositors that wanted their money out. FDIC catches wind of this, comes in, does an examination, shuts them down. So you get a scary event on Friday that Silicon Valley Bank is being shut down. So this is a different thing than what happened in '08. That was on the other side of the bank balance sheet, which is the credit side, where you're making loans that you don't have accounted for, or you've packaged securities that you don't understand the prices of, and then they had to panic sell to cover those credit losses. This is on the deposit side. So then the Fed did is what they're calling a systemic risk exception. So with FDIC insurance, we can all get our $250,000 plus, depending on how our accounts are titled, if they're in trust, things like that, from these banks through the FDIC. So what they decided to do through the Fed and through the Treasury is this risk exception where every depositor is going to be made whole at Silicon Valley Bank. They did this on Sunday, and they did it for a reason. They did not want a bank panic on Monday. They didn't want everybody running into their banks, taking their deposits out, because they didn't know if the bank would be around later that week. And so based on stock performance and some of the other dynamics over the last 48 hours, it appears to have worked for the time being. And I don't think, and I've read a lot of folks that I respect feel the same way, this isn't a sky is falling kind of event, but it's definitely something that caused a lot of heartburn and challenge in the middle of the crisis. And now as we go forward, it kind of asks us, what does this all mean? So what we're looking at now is is this systemic, which means is it going to infiltrate the whole system, the whole bank system, or is it symptomatic? And I believe it's the latter. It's symptomatic of zero money and the dynamics that always exist in the markets, which is fear and greed. And so this bank got greedy, in my opinion. They're all going to be fired as a result of it. They've created a new dynamic that's going to have to be examined and thought of, and how banking works when you're involved with crypto and venture and startup and just highly risky stuff. We've seen it before, back to Enron or other companies that took risk that they couldn't afford if things changed. And like we'll be in 3 months from now, we'll be talking about something different. Well, 3 months ago, we weren't talking about bank failures, but now we are. And so this is what happens, and many executives and stuff did not plan for it. And so as a result, you had the fallout from this. So it's going to create some heartburn, definitely in the regional banks. Some pricing is going to get reset. I think there's going to be a push for more increased regulation. These guys are all going to get called before Congress. You can count on that, and you know how that's going to go. Lots of lamenting and gnashing of teeth and everything. But what it means for all of us is I think it's going to change a little bit, this whole dynamic of rates going up super quickly like they have been. So the Fed's been raising aggressively, hoping to bring down inflation. Well, we saw the print come out today, and it did come down a little bit. It's still high at over 6%. But the belief has been they're going to keep raising rates aggressively. Chair Powell just last week mentioned that he probably would continue to be aggressive. Well, this bank issue might slow that whole thing down a little bit. And so as long as the Fed is raising rates, I'll continue to say this because I've spoken to Marianne Bartels and others that we reflect on this. As long as they're raising rates, we're going to have volatility. If you're going to have things like bank failures, you're going to have volatility. And so the challenge for all of us is to know that we're diversified and we don't have the risk of just dealing with one part of the market, and definitely not just one or two banks that could create this kind of heartburn. So they did what we advised always not to do. They concentrated their risk. They got caught. And when the chips were down, all of their wealthy investors began to just flood, 40 plus billion out of that institution. And so while I think it's symptomatic, I don't think it's systemic to the whole system. But I do think it gives us a good reason to continue to preach diversification and to follow where our risk is in our portfolios and understand the bonds that we own. And if we buy them at a discount, we know that we can hold them to maturity and get that par value back. All the fundamentals come to play when this kind of event comes to roost. So we'll be staying the course and getting portfolios, they're already in good shape and not systemic to all of this. And so we'll just keep doing that work like we have been. So I want to thank you all for joining us today. I just wanted to have a quick session here, and thank you all for joining us. We'll record this and send it out via email. If you have any questions or want to follow up, please just let me know. Thank you.